Gold and silver prices shouldn't have even been going down. They should have been going up a lot over the past year. So the fact that they went down surprised a lot of people. A lot of people were curious as to a gold market turn. For years and years and years, the Fed kept creating inflation. QE1, QE2, QE3, Operation Twist was thrown in, and then we went to QE4, all the while saying there's no inflation. In fact, there's not enough inflation. Inflation's not even 2%. We need more. We need to keep on printing money. Printing money is inflation. QE was inflation. The problem was the effects of inflation were just postponed until last year. That's when we really started to feel the sting of the inflation that the Federal Reserve spent a decade creating. Of course, Americans felt the sting a lot earlier than that. It's just that it didn't show up in the CPI because the way the CPI has been rigged, you need to have 5 or 6% inflation before it's 2%. So by the time we got 7, 8, 9% inflation, it was much higher than that. It's probably 15 to 20%, but it's now so bad that they can't hide it anymore, and so they have to acknowledge it. And now inflation has become the problem. Before, inflation was the solution to the problem. That's how the government got us out of the financial crisis. They created inflation. That's how they tried to get us out of the COVID manufacturing crisis. They created inflation. All of this was to delay the pain. Well, we traded the pain of a financial crisis or of a depression for the pain of inflation, except the pain didn't seem that bad until last year. But anybody who thinks that the inflation that we're experiencing now is merely a consequence of the reckless monetary and fiscal policy following COVID still has no idea what's going on. We are paying the price for a decade, maybe 2 decades. It really started in earnest in 2001, 2002 of reckless monetary policy, where we just created massive inflation and we built an economy on inflation and on cheap money and artificially low interest rates. The Fed cannot reverse that. It's impossible for the Fed to actually fight inflation, but they can't admit that, so they had a bluff. And recently, with the inflation numbers getting worse and worse, they had to actually start delivering on those commitments. They actually had to start raising interest rates significantly and pretend that they were going to keep on doing it. Well, that really put a gashing hole in this bubble. And the markets, of course, went into a bear market. But where we started to see the big cracks was last week. I pointed this out when the Bank of England became the first major central bank to have to capitulate and pivot and go back to quantitative easing after promising quantitative tightening to prevent a financial crisis in the UK that had already started blowing up in pension funds, but it would have dominoed once those pension funds were forced to liquidate their gilts and had their margin calls. It would have been a domino effect. There would have been a financial crisis in the UK had they not given up the inflation fight. And they've probably given it up for good, because if they restart it, well, they're just going to be right back into the mess that they were in. And now over this weekend, you started to really see the investment community looking at some of the banks. Credit Suisse was the one a lot of people were talking about over in Switzerland. But these banks have been levered up on cheap money. They are going to be the primary losers in a financial crisis, just like they were in 2008, because they are the creditors. They were gorging on all this cheap money. They were extending all this bad credit. And when interest rates are near zero, these bad loans can survive. But as the Fed is raising interest rates, a lot of these loans were going to go into default. There were going to be major bankruptcies and foreclosures, and we were going to have a worse financial crisis than 2008. 2008 was all about too much debt and the inability to pay. Well, we've got a lot more debt now, and we're even less able to pay. The only thing that kept it going was the artificially low interest rate. And Janet Yellen said, well, don't worry about the national debt. Doesn't matter. Look how low interest rates are. Just focus on the servicing costs of the debt. Doesn't matter how much debt we have. Look, it's hardly costing us anything to pay the interest. Well, look at it now. Interest rates, short-term rates have gone from basically nothing to 4%, and they're headed from 4% to 8%. The cost of financing the national debt has already increased by a factor of 16. If you figure from 25 basis points to 400 basis points, that's a 16-fold increase. So if the debt wasn't a problem because it was so cheap to finance it, well, it's a huge problem now when the cost is 16 times higher. And as all this debt starts to mature, it has to roll over at these higher prices. Look, we are very close to another financial crisis. And I think what happened in the UK, and now all of a sudden, looking at what's happening in Credit Suisse and other banks, people are starting to actually question the insanity of the narrative that they all believed in, that the Fed could actually raise interest rates to 4 or 5%, and that all hell wasn't going to break loose. I mean, remember, what happened in 2018? The Fed got to 2.5%, and everything started to collapse. We had the biggest drop in the stock market in the fourth quarter since, I think, what, the Great Depression, the worst December since the Great Depression, and the Fed had to call off quantitative easing back then, and the balance sheet was only $4 trillion. It's now closer to $9 trillion. Think about all the debt that we've taken on since 2018. If the Fed really couldn't get interest rates above 2.5% back then, it's already got them above that now. And so we really would be imploding. And so what I think is going on is the markets are finally just questioning this. They still haven't really figured it out. They still haven't figured out the rock and the hard place that the Fed and the country are between. Because the Fed is going to have to pivot, but inflation is going to run out of control. See, they've got to make a choice. Do they want inflation or do they want economic implosion? Now, ultimately, if they choose inflation, we're going to have an implosion anyway because we're going to have hyperinflation. It just may happen a year later. And, well, that's good enough for the politicians. All they care about is that it doesn't happen now. Because to fight inflation, and there's only one way they're going to fight inflation successfully, which is why they can't do it. They've got to raise interest rates above the rate of inflation. And inflation is what, 8%? Even if it's 6%, they got to get short-term interest rates up to 7%. They're barely at 4%. They got a long way to go. And they've got to have massive cuts to government spending. They're not even considering that. Because right now, the way the government pays for spending is with inflation. Inflation is the stealth tax by which the government pays for everything. In fact, going all the way back, how did we get all this government? We didn't get it for free. We paid for it with inflation. They created money to pay for all this stuff. Now, if the government wants to get rid of inflation, they have to get rid of that money. And so they have to run budget surpluses. The Federal Reserve has to be able to withdraw all the liquidity that it's supplied. If the government chooses inflation, then inflation is going to wipe everybody out. So everybody's going to get wiped out through deflation when this whole thing collapses and a crisis, or they're going to get wiped out through inflation.